outperforms most investors. Passive investors aim to be the market rather than beat it. They choose index funds because they get the market return. Over lengthy periods, the S&P 500 is returned around 10% annually. Passive investors become active traders, who frequently fail. It's simpler. Passive investing is significantly simpler. Index funds require no research, stock selection, or labor. Passive investing, as suggested by Warren Buffett, is easier than ever with low-fee mutual funds and exchange-traded funds. Tax deferral. Buy and hold investors pay less in taxes because they can delay capital gains taxes until they sell. Quick. Passive investors should only check their portfolio for 15 to 20 minutes at tax time. Instead of investing, you have time to do whatever you want. Let corporate success drive your returns. Buy and hold investors' returns are driven by the underlying company's success, not by their trading skills.